No one really is talking about it, which is kind of crazy. And, look, I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it just makes my disdain for the legacy media grow by the day. Our massive debt means that we will almost certainly rely on money printing to pay it back, which erodes the value of the dollar. Foreign holders of our treasuries and our dollars do not want inflated dollars, so they too are shifting into gold. And it's because of the credibility, the liquidity, the physical security. This is what has shifted gold's bull run from $1,700 to $3,500 an ounce in just the last 3 years. And then at the same time, you got momentum building with guys like Putin and Xi and Modi who are openly urging trade in local currencies, which again are laying the groundwork for a world less dependent on the dollar, done again. And that's, this is what it is. It's not so much gold, it's the dollar, it's everything. Gold is the barometer by which we measure everything else. And when you have a treasury that is projecting well north of 22 to 25 trillion in debt in the next several years, with our foreign creditors who have supported our lifestyle backing away, I don't know, isn't it always been the Fed that stepped in and with more money printing, risking inflation? I don't think this is panic. This is a sober reality. Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record, speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And wouldn't surprise me, and then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. This will probably, I doubt people would get this, maybe people watching your show, but if you bought, what do you think was the best performing asset if the day Nixon closed the gold window on August 15th, 1971. Well, obviously I'm asking the wrong crowd, but number one was gold. Number two was the S&P 500. Number three was the Dow Jones. Number four was silver. And this is including reinvesting every dividend for compounding gains, which no one ever does. Investors never do that. But if you had invested every single dividend for the past 54 years, gold is still outpaced the Dow and the S&P. Silver came in just behind those at number 4, but it goes to show the old adage that Wall Street wants us to believe that because there is no yield on gold, you should have known it. It's actually a joke.
If you price things in gold, you get to see what they really are priced. He says we've been in a bear market for 2 decades on the stock market.
Yeah, in just about anything that you measure it against. In all valuations, don't measure it against the dollar, measure it against gold, and you'll see in terms of gold, things are getting cheaper. I expect that the price of gold only goes higher because, as Michael Oliver, who you have on your show all the time, he's talking about a real massive capital rotation from Western mainstream legacy investment stocks, bonds, etc., into precious metals. He says this happens but once only every 50 years. Doing a little bit of reading this weekend, found it very interesting that before Scott Bessent became the U.S. Treasury, he wrote this. I'm going to read it from his January 2024 Key Square Capital Management letter. And then I want you to think about where we are right now today and his role in all of this. We believe that this, and again, he was writing this for a letter. He was a capital management letter that he was working for in 2024. We believe that this inappropriately easy policy, monetary policy they're talking about, inflated the dot-com equity bubble. Our best case is that a re-elected Donald Trump will want to create an economic Lollapalooza and engineer what he will likely call the greatest 4 years in American history. In this scenario, here's the important part. The greatest risk factor, in our opinion, would be a sudden rise in long end rates. I find it interesting. I think this explains why he's so much into gold. And, this is where we're going. This is the path that we are heading on. I also found it interesting that Besant just also advocated for a comprehensive independent review of the Federal Reserve. He called for scrutiny of the entire operation, its monetary policy, its regulation, its staffing, its communications, blah, blah, blah. He argues that the Fed has strayed beyond its mandate and needs to regain credibility as a non-political institution. He said that the Fed should relinquish its banking supervision duties and limit economic intervention, particularly unwarranted bond purchases outside of crises. But this is with President Trump's effort to increase influence over the Fed. So if that happens, you look at Stephen Mirren being put in and Trump's attempt to sever the independent. Isn't that exactly what Goldman Sachs was warning about? That the political control harms its credibility, increases inflation, undermines its trust. Bang, gold goes to 5,000. So it's happening right now. I mean, you can see it as being undermined. And so, I think that one should expect gold to go much higher in the face of a dollar going much lower and the Federal Reserve losing independence, as Goldman Sachs has so eloquently spoke of.
Look, no one's really talking about this. And that blows my mind, because what we're witnessing isn't just another gold bull market. It's not just the dollar losing a few points on the DXY. This is a monetary reset. It's a wholesale reshuffling of the global financial deck. And while CNBC is talking about AI stocks, Taylor Swift's tour revenue, or whatever shiny object of the week, the real story, the one that will define your financial survival, is being ignored. Here's the key point you've got to internalize. Gold isn't going up. It's not that gold suddenly woke up, hit the gym, and got ripped. What's happening is that currencies everywhere are going down. They're being debased, destroyed, inflated away. Not just the dollar, but the euro, the yen, the pound, the yuan, you name it. Gold is the mirror that shows us just how weak our paper has become. And let me be crystal clear. When you see foreign governments and central banks holding more gold than U.S. treasuries, that tells you something. It tells you they trust gold more than they trust our debt. They're basically saying, we'd rather own rocks that came out of the ground than promises from Washington. That's a reset. That's not a theory. That's a fact. Now you can shrug your shoulders and say, well, Andy, who cares? This is above my pay grade, but it matters. Because the system we've all grown up in, where the dollar is the unquestioned reserve currency, is breaking down. The only reason America has been able to run trillion-dollar deficits year after year is because foreigners kept buying our debt. They kept recycling dollars back into treasuries. But now, they don't want inflated dollars. They don't want bonds paying 4% when inflation's running at 6%. They don't want promises from a government with $35 trillion in debt and no plan to pay it back. So what are they doing? They're buying gold. They're hoarding it. And that's why we've seen gold rip from $1,700 to $3,500 in just 3 years. Meanwhile, guys like Putin, Xi, and Modi are openly urging trade in local currencies. India's buying oil from Russia in rupees. China's signing long-term LNG deals in yuan. The Saudis are cutting deals outside of petrodollars. These aren't isolated stories. This is the scaffolding of a new financial order being built in real time. And what's our treasury projecting? North of $22 to $25 trillion in new debt in the next few years. That's not the total, it's the increase. And historically, when foreigners stop funding us, the Fed steps in. How? With the printing press. They don't call it that. They call it quantitative easing or balance sheet expansion or some other euphemism. But it's printing, it's inflationary, and it destroys the value of the currency even more. Here's the sober reality. Confidence in the dollar is slipping. Confidence in the Fed is slipping. And gold and silver, with their 5,000-year track record, are becoming the fallback. That's why Goldman Sachs is out there saying $5,000 gold. That's why independent analysts are pointing to $9,000 if even 20% of Treasury flows reallocate. And you know what? That wouldn't surprise me one bit. Let me share something funny with you. I saw a guy tweet, "When gold hits $5,000, I'm buying Tesla stock." And I had to laugh, because if gold hits $5,000, you won't want Tesla stock. You'll want food, you'll want fuel, you'll want security, you'll want real wealth. That's the point. You don't buy gold and silver to get rich. You buy it to stay rich, to not get wiped out when the paper burns. Now let's bring in a little history. August 15th, 1971. Nixon closes the gold window. Since that day, if you chart performance of assets, what do you see? Number 1, gold. Number 2, the S&P 500. Number 3, the Dow Jones. Number 4, silver. And that's even assuming you reinvested every dividend, which nobody actually does. In other words, for 50+ years, gold has beaten the stock market. Silver's right behind. So the Wall Street narrative that gold has no yield is a joke. Gold's yield is preservation of purchasing power. It's outperformance in the one metric that matters: survival across decades of inflation, crises, and resets. If you price the stock market in gold, not dollars, you'll see the truth. In real terms, the market's been in a bear phase for 2 decades. The dollar clouds it. Gold clarifies it.
Oh, there's no question. You're seeing, the numbers in all of vaults, except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But 7-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it. SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain, look at like Saudi Arabia, who took this huge position in SLV. The one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving, and the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 3640 divided by 7, which is the geologic ratio, it's actually 520, so let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure.
All right, so let's roll up our sleeves and go deeper, because this is where the rubber meets the road. In part 1, we laid out the framework. Currencies are depreciating, gold is the barometer, central banks are buying hand over fist, and the Fed is losing credibility. But now we need to talk about how this plays out, how the mechanics of the system itself are cracking. Start with COMEX, the futures market. Everyone in the industry knows it's a fractional reserve system. The contracts are supposed to be backed by physical metal, but the amount of paper contracts dwarfs the actual metal registered for delivery. 10, 20, sometimes even 50 paper claims to 1 real ounce. For years that worked because most people never stood for delivery. They just rolled contracts over. It was a casino, and the house always won. But lately, things are different. Buyers aren't playing the game anymore. They're buying contracts and immediately standing for delivery. And instead of contracts dwindling into expiry like they used to, the numbers are rising, sometimes doubling, sometimes tripling. Think about that. The very thing COMEX hoped would never happen, people actually wanting the metal, is happening. And here's the Achilles heel. If even a small percentage of contract holders demand delivery at once, the system fails. You get a failure to deliver. And if that happens, confidence in the entire market implodes in 72 hours. Think about the psychology. When someone's told they can't have something, what do they want more than ever? Exactly. If silver contracts fail to deliver, suddenly every trader, every hedge fund, every sovereign wealth fund says, "Give me the metal." That's the stampede moment. And when confidence breaks, the whole edifice collapses. Now let's talk ETFs like SLV and GLD. On paper, they're supposed to be backed by physical. In practice, they're weapons for suppression. When big money flows into SLV, instead of draining physical, the banks can use that to create more paper. But there's a twist. If an entity, say Saudi Arabia, buys a stake large enough, they can demand delivery. That's exactly what we've seen. Same thing years ago when Kyle Bass got the Texas Teachers Union to put $1 billion into gold. He demanded the bars. Took them out of GLD, so while ETFs are manipulated tools, they can also become Trojan horses. Big players can use them to raid the vaults. Now picture this. You've got sovereigns, pension funds, billionaires quietly draining physical, while retail investors argue about whether Bitcoin's going to $100,000. I saw a tweet the other day that made me laugh out loud. Gold is for boomers. I'm all in on meme coins. Well, guess what? When the reset comes, your meme coins won't buy you bread. Your ounces will. That's not me being dramatic. That's me being historical. When confidence in paper dies, only real things matter. And look at the numbers. Gold's around $3,640. Divide that by a 70-to-1 ratio, and you get 52 silver. Divide by 40-to-1, the 100-year average, and you get $91. Divide by the geologic ratio, 7-to-1, and you get $520. And if Goldman's right and gold hits $5,000, at 70-to-1, silver's $71. At 40-to-1, it's $40, $125. At 15-to-1, which is the natural monetary ratio, it's $333. That's not pie in the sky, that's math. And yet silver today is still under $50. It's like buying a mansion for the price of a shack, and big money knows it. They're hoarding, they're front-running. Now here's the predicament for the elites. In the old days, if you wanted to park wealth, you had options. You bought treasuries. You clipped 6, 7, 8% coupons. You compounded. The law of 72 worked in your favor. 9% doubles your money every 8 years. But today, Inflation's 6, 7, 8%, and treasuries pay 4. You're locking in a loss. Bonds are a no-go. Stocks, valuations are at record highs. Margin debts at record highs. Options exposure is off the charts, and insiders are selling while the public is piling in. Real estate, 30 years of suppressed rates have blown that bubble to the moon, and now with mortgages back near 8%, affordability is wrecked. So where do you go? Where do you park billions safely? There's only one answer: gold and silver. That's why you're seeing billion-dollar orders quietly being filled. Not on CNBC, not in the Wall Street Journal, but in the trade data. And you know what? This isn't conspiracy theory. Even BlackRock has admitted in the SLV prospectus, be careful if you're short. There may come a time when there isn't enough silver to cover positions. They literally wrote that down. That's not Reddit. That's the world's largest asset manager admitting the system could break. So the first stage is hoarding, the second stage is a squeeze, and the third stage, a reset. Now let's talk about what a reset looks like. History gives us clues. 1944, Bretton Woods. The dollar becomes the reserve backed by gold. 1971, Nixon closes the gold window. Reset. Dollar untethered. Every major shift in the system has come with revaluation of gold. In 1933, FDR confiscated it at $20.67 and revalued it to $35. That one move inflated away debt, reflated the economy, and broke deflation's back. That's what a reset does. It destroys the creditor, saves the debtor, and shifts the playing field. So what happens this time? Our government's bankrupt, our currency's distrusted, our debt's unpayable, and foreign creditors are bailing. The logical step is another revaluation. Peg gold higher to backstop confidence. Judy Shelton's even floated pegging treasuries to gold. Imagine $10,000 gold, $300 silver, not as speculation, but as policy. And don't think it can't happen. When confidence breaks, politicians do whatever it takes to restore order. Printing, confiscation, revaluation. Pick your poison. Now, some of you are probably thinking, okay, Andy, but why isn't this all over the news? And that's the million-dollar question. Why aren't the anchors on CNBC screaming about central bank gold buying? Why isn't Bloomberg running headlines about sovereigns dumping treasuries? Because the mainstream exists to maintain confidence, to keep the game going. If they told the truth, that the dollar's in decline, that foreign governments are losing faith, that the Fed is politicized, you'd have panic. So instead, they talk about AI, Taylor Swift, and IPOS. But here's the beauty, that ignorance is your opportunity. You're early, you're awake. You can act before the herd. Let me inject a little humor here, because this gets heavy. Someone sent me a meme the other day. It was a Monopoly board, but every square said, pay with gold. Even get out of jail free cost a silver coin. It was funny, but also profound. Because when the paper burns, the game changes. And if you're holding metal, you're playing with a different deck. So what do? Step 1, self-sufficiency. If you can't feed yourself, gold won't matter. If you can't protect yourself, silver won't help. So start there. Food, water, security. Step 2, remove intermediaries. Don't just own ETFs or pooled accounts. Own physical, in your hand or in allocated storage. Step 3, diversify into companies that produce real things. Energy, agriculture, essentials. And if you own stocks, get certificates. Because as David Webb warned in The Great Taking, bail-ins are real. Legally, your stocks, your bank deposits, your insurance cash values are owned by the institution, not you. You're just a creditor. And when the next 2008 hits, you'll be the first sacrificed. That's not theory, that's law. The ink is dry, so get certificates, get ounces, get tangible. And let me make this point clear. Less than 1% of the population owns physical gold or silver. That's it. So when the revaluation comes, when the panic hits, you don't need the world to wake up. You just need 2, 3, 4% of capital to rotate. That's trillions. And that's enough to send metals parabolic. Think of it like a fire in a theater. If everyone rushes for the exit at once, it doesn't matter if only a small fraction gets through. Prices don't just rise, they explode. So here's where I land this plane. We are witnessing the slow-motion birth of a new system. It's not gold going up. It's currencies going down. It's not conspiracy. It's math. It's history. And it's playing out before our eyes. And in the end, when the dust clears, those who held physical gold and silver will be the new banks. They'll have capital when everyone else has paper. They'll have trust when everyone else has IOUs. They'll be the foundation for whatever comes next. So don't wait for CNBC to tell you. Don't wait for the Wall Street Journal headline. By then, the theater will be on fire, and the exit doors will be jammed. Act now. Protect yourself. Hold real money. Because resets don't come often, but when they do, they change everything.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.